Hello everyone. We are here today to take a brief look at the month gone by, that is June 2022. It's been more than 4 months since the war in Ukraine began, and the impact continues to worsen. There has been some important shift in trade flows between the countries. EU has banned imports of Russian seaborne oil. Russia retaliated by restricting gas supplies to Europe. This sends global energy price further higher, though other commodities have corrected a tad over last 2 months. Food and energy prices could stay elevated in the near term. As we speak, there are some 23 economies which are restricting food exports from their country. Eventually, as likelihood of softer growth ahead takes a stronger hold, commodities should soften. In China, regional lockdowns are starting to ease, offering some unclog to supply chain disruptions. Economic activity in China improved marginally in June. Any recovery in Chinese economic activity will be muted till zero COVID-19 strategy remains in place. Central banks have consistently reminded us that there's nothing they can do to influence these global supply shocks. So their task now is to set the policy in a way that lowers domestic demand, particularly labor demand, in order to curb wage growth and wage spiral. With an exception of a few, pretty much all central banks are focusing strongly on inflation. US Fed hiked Fed funds rate by 75 basis points in June 2022 to 1.5 to 175 range. Fed dot plot and market expectations price a terminal rate in the US to 380-390 by mid-2023, but then to ease in 2024 as growth weakens. Such aggressive rate actions have fueled the discussion of recession in the US. Historically, Fed rate above 3% levels have led to recession in the country. For now, models attach a low probability of recession in next 12 months. Global PMI in developed economies moderated a tad, but those in emerging markets stayed healthy, while for China, it rather improved. Indian economic activity too continues to improve on a sequential basis. Employment is heading above pre-COVID levels. Households are increasing the volume of their spend, particularly on travel and recreation. Government spending is robust on a YOY basis. Bank credit has picked up. Housing sales hold momentum despite 75 basis point rise in mortgage rate over last quarter. Some moderation are seen in exports. Rural economy trend also rather look mixed, and a slow start to monsoon and sowing needs to be watched out. Government is taking multiple tax and policy measures to draw a balance between inflationary concerns and twin deficit. This pace will be quite dynamic through the year. Very early to call out on eventual fiscal outcome. We stick to the stated fiscal deficit targets for now. Rupee was a highlight of the month, having depreciated to 79 against US dollar. Most global currencies have depicted similar depreciation against dollar. Two forces are working towards strong dollar: hawkish Fed and the possibility of slower growth going ahead. The US dollar has historically thrived during cyclical downturns. As such, dollar could strengthen further and its overvaluation could still endure. In India, Rupee could touch 80 against US dollar in the interim. Eventually, once commodity corrects meaningfully or the FII outflow stops or rather reverses, we could see it trace back to 78-79 levels against US dollar. Current currency market dynamics will also influence rate actions in India. Coming to the equity market, Nifty fell 4.8% during the month, still marginally better than MSCI EM and S&P 500. Small and mid cap showed a rather sharper fall of 6% each. FIIs have sold $34 billion since October 2021, almost entirely reversing the $38 billion that was bought post COVID 19. DIIs continue to buy, aided by strong sticky flow into domestic mutual funds. Corporate profits to GDP recovered to above 4% in FY22. There could be near-term hiccups to earnings. However, we expect profit to GDP ratio to improve in the medium term. Thus, it is the valuation premium coupled with drawdown of global liquidity and rising interest rates which command near-term caution to the equity outlook. Beyond the near-term turbulence, it is likely that economy is at the beginning of a new capex-driven economics and earnings cycle, and therefore investors are advised to use any sell-off in the pro-economy stocks to act from a mid to longer term perspective. Fixed income space was volatile in June. 10-year US Treasury rose to 350 by mid-June and then retraced to 290 levels in a matter of few weeks. In India, RBI hiked repo rate by 50 basis point in June review to 490. Stance guided for withdrawal of accommodation. Inflation projections were revised up significantly from 570 in April to 670 in June, in line with the street expectations. We believe inflation is likely to hover around 7% mark for the next couple of months before it lowers to near 6% handle. Quicker policy rate adjustment seems more likely rather than a long drawn out process of rate adjustment, considering the domestic and external backdrop, and repo could go to 6% in this fiscal. Banking system liquidity has fallen sharply to 2 trillion by end June, though durable liquidity has fallen from 10 trillion at the start of the quarter to 6 trillion by now. The gap is explained by higher government cash balances. The quarter gone by has seen a decent demand during all auctions of government bonds, but this was also partly because SDL supply was only half of what was expected. Eventually, these supplies should pour in subsequent quarters, and demand-supply dynamics then needs to be watched out very closely. We will wait therefore before structurally adding duration. Though adequate flexibility in duration mandate would enable debt investors to navigate the changing times and volatile market. In this context, rather than target a specific level on the benchmark, investors with a duration appetite may choose to incrementally take exposure on a staggered basis over the coming months as RBI continues to normalize the monetary policy settings. That's for this month. In the comment box below, do let us know where does your preference lie between the debt and equity in the current market environment. Would you add duration at the current levels? Signing off for now. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.